Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden stories behind corporate pronouncements. It's been another fascinating quarter. And today we are diving headfirst into Dynatrace Incorporated's latest 10. Q filing to uncover what truly lies beneath the numbers before we dive in. If you love getting straightforward, no nonsense insights from company filings, make sure you are subscribed. We have a fantastic community growing over on Discord full of fellow analysts and corporate junkies, so join in through the link in the description below. Alright, let's get straight to it. Dynatrace, as of the 30th of September 2025, their total assets stood at over $4 billion, a slight decrease from the 31st of March 2025, which makes sense given the way they manage their investments. But it is worth noting that their cash and cash equivalents alone were over $1 billion. That is a very strong position to be in. Now let's talk about accounts receivable. This is what customers owe them, and it dropped significantly from over $600 million in March to just over $300 million in September. That could mean faster customer payments or fewer new sales being booked in the immediate short term before September, but overall healthy. This is a really interesting number for subscription businesses like Dynatrace. Deferred revenue is money they've received for services not yet delivered, and their current deferred revenue was over $800 million, a decrease from over $1 billion in March. This suggests they are recognizing revenue faster than they are booking new upfront payments, which can be good for current income, but means less future guaranteed income visible right now. Looking at their income statement, total revenue for the 3 months ending the 30th of September 2025 was nearly $494 million, up 18% from the previous year, and for the 6-month period it was over $971 million, also up 19% year over year. This shows consistent growth, which is always a good sign. Subscription revenue is the lion's share of that, almost $473 million for the quarter and over $930 million for the 6 months. This is their core business. Subscription growth is strong and makes up 96% of their total revenue. This shows customers are sticking with their core offerings. Now, the cost to deliver that subscription revenue increased by about 23% for the quarter and 22% for the 6-month period, outpacing overall revenue growth slightly. This is largely due to increased cloud hosting costs and personnel expenses as they scale up to support more customers, a necessary expense for growth, but something to watch. This means their gross profit was over $404 million for the quarter and nearly $800 million for the 6-month period. A healthy increase mirroring their revenue growth, showing they are managing costs effectively within their core subscription business. Their investment in the future research and development expenses jumped about 21% for the quarter and 22% for the 6-month period, driven by hiring more engineers and investing in their platform. This is essential for staying competitive in the tech world. Sales and marketing expenses also saw an increase of 16% for the quarter and 15% for the longer period, again largely due to hiring more sales staff to drive that revenue growth. Despite these investments, income from operations came in strong at over $72 million for the quarter and over $135 million for the 6-month period, both significantly up from the prior year. This indicates they are growing efficiently, and that translated to net income of over $57 million for the quarter and over $105 million for the 6-month period, which is a positive trend from the prior year. Looking at their key metrics, their annual recurring revenue, or AR, as of the 30th of September 2025 was over $1.89 billion, a solid 17% growth year over year. Their dollar-based net retention rate was 111%, meaning existing customers are spending more with them over time after accounting for churn. Not bad at all. It means their product is sticky and expanding within accounts. Their non-GAAP income from operations, a measure that excludes certain items like stock-based compensation, was over $152 million for the quarter and nearly $300 million for the 6-month period, also showing strong operating performance. And their free cash flow, which is cash generated after accounting for capital expenditures, was over $27 million for the quarter and a massive over $289 million for the 6-month period. This is really impressive, showing they convert their profits into actual cash very effectively. Now let's look at where the money is coming from. North America still dominates, accounting for 51% of their revenue, followed by EMEA at 32%. The United States alone specifically is responsible for 45% of their revenue. This geographic concentration is a known risk factor, but also shows where their core market is. This is a forward-looking indicator. Remaining performance obligations were over $3 billion, of which they expect to recognize over 52% in the next 12 months. That is a good chunk of future guaranteed revenue. Their goodwill, which represents the premium paid over fair value for acquired assets, increased slightly to over $1.3 billion. This growth is mainly due to currency impacts, suggesting no major acquisitions recently, but their existing intangible assets are being amortized down. In terms of debt, they have a credit facility for $400 million, but as of the 30th of September 2025, there were no amounts outstanding under it. This is excellent. They are not relying on debt financing, which significantly reduces risk. Dynatrace has a share repurchase program up to $500 million, and for these 6 months they repurchased nearly 2 million shares for about $95 million, leaving over $232 million available for future repurchases. This could signal confidence from management in the company's valuation. Now let's talk about the risks they're flagging, as you'd expect for any growing tech company. They are concerned about competition, innovation delays, and market adoption. They openly admit that prediction of their results is difficult due to many factors, many outside their control. This is standard, but emphasizes the volatility inherent in the tech sector. This is a significant risk they face if customers stop finding value or competitors offer better solutions. Their growth could stall. Essentially, if companies cut back on its spending, Dynatrace feels it directly. The global economic uncertainty is a constant worry for them. This is the core of it. If they don't keep innovating, they will fall behind, extremely important for a company in the fast-moving observability space. Compatibility is key for Dynatrace. If their system doesn't play nice with other technologies, customers will look elsewhere. This is fundamental to any business model, and Dynatrace is no exception. Maintaining and growing their customer base is critical. They face competition from various players, including large tech giants. This is a crowded space. Data security is a massive concern, and a breach could severely damage their reputation and trust. Just because they build it doesn't mean it is perfect. Any glitches could create big problems. Protecting their intellectual property is crucial for maintaining their competitive edge. This is a complex area where using free tools might come with unexpected obligations and legal entanglements. This is a newer risk focus for many companies, acknowledging the potential disruption climate-related events could cause. Standard risk for public companies: too many shares hitting the market at once can depress the price. So if you are looking for dividend income, this is not the stock for you. Your return hinges on stock price growth. Overall, Dynatrace appears to be a financially strong company with consistent revenue and earnings growth driven by its subscription model. They are investing heavily in R&D and sales to fuel future expansion, and their impressive free cash flow generation is a major positive. The biggest challenges lie in navigating the highly competitive observability market, staying ahead of technological changes, and managing the ever-present risks of cybersecurity and potential economic downturns. Their strong AR and net retention rates suggest customers find significant value in their platform, which is a great sign for long-term health. Alright, that is our deep dive into Dynatrace's latest filing. What do you think about their performance and their future prospects? Do the risks outweigh the rewards? Let me know your thoughts in the comments below. If you found this analysis valuable, hit that like button. It really helps us out, and subscribe for more decoding of the corporate world. And don't forget to join our growing community on Discord. The link is in the description. Thanks for watching, and we'll see you in the next one.